this is Jitan here and welcome to TradersTV. Now you may have heard the term margin when you're looking at Forex trading and starting out. It's a term that a lot of brokers use, but a lot of retail traders just don't understand what it is. But it is hugely important towards your trading success. So in today's video, we're going to discuss what margin is, the pros and the cons, and how to use it to your advantage. So let's get to it.
So margin can be your best friend, but it is really a double-edged sword if you don't understand it and if you don't use it properly. So let's have a look at what margin is and why all Forex traders actually use it. So all Forex traders use margin trading to help leverage their trades. Leverage is the ability to control a large sum of money with very little of your own whilst you borrow the rest, from this case, from your broker. Right. So let's say, for example, you see some advertising or whatever, and your broker says you have 100 to 1 leverage on the foreign exchange market. This basically means you can control a $100,000 position with just $1,000 in your trading account. But of course, leverage is a double-edged sword because you could be making profit off the $100,000, but also losses as well. So it is very, very powerful, but you've got to learn to respect it. Okay. So how does margin fall into the leverage? Well, margin is basically the amount of money used as a good faith deposit to open a trade with your broker. So every broker will require a different amount of margin to hold a trade open, and it will vary from market to market. So very new markets like cryptocurrencies may have a slightly higher margin requirement because they're much more volatile markets and not as big as, let's say, the US dollar right now. Trading things like the US dollar or the euro currencies, margin requirements typically need to be a little bit less because they're very, very liquid markets. They're huge markets. So it will vary depending on the market, and margin will vary depending on the market you're trading. Okay. Now, Forex is so liquid, so brokers require a lower margin to hold positions open. But beware, there's a lot of brokers out there who advertise 1,000 to 1 margin, and you just got to be really, really careful that you understand what it actually is. Now, the way we trade and the way we teach about trading is to manage risk properly. So you're always in line with the margin requirements and margin guidelines. Okay, and we have specific risk parameters to risk per trade. We have specific risk parameters for currency risk, portfolio risk, trade risk. So we have a basket of rules to help us manage margin and actually use it to our advantage rather than it becoming a disadvantage to us, which it does for many traders who aren't in the know. Okay. So the margin amount is typically shown as a percentage of the full amount of the position. Okay, so let's say you had 100 to 1 leverage. Well, this basically means on 100 to 1 leverage, to trade or to manage a $100,000 position, you only need $1,000 in margin. Okay, to have that position open. So this represents 1% margin requirement. So the margin is always expressed as a percentage of the full amount of the position. So if you have a 20 to 1 leverage, that means you have a 5% margin requirement. 50 to 1 leverage is a 2% margin requirement, and so on. As I said before, margin is very powerful, but make sure you always think about the downside risk too, as your losses could be bigger as well. So this comes back to the thing, you've got to have specific risk management guidelines within your trading to make sure that you use margin to your benefit rather than it becoming a disadvantage. So some of the key requirements you need are things called trade management. So you need to know what you're risking per trade. You need to know what your currency risk is, your overall currency risk is. You don't want to be long on €6 long positions at any one time. It may be okay for some people, but if you're risking 5% a trade, you've got 30% of risk on euro to the long side. It's too much. Okay, you may have used up a lot of your margin that you may not be able to take a hedge in another market, or you may not be able to take another position, which looks even better. All right. Also, you need to know what your portfolio risk is going to be as well. So at any one point in time, just managing that portfolio risk. So we have and we abide by strict rules in all of those scenarios. So we're making sure we use margin to our benefit rather than it being a disadvantage to us. And risk management is really the hallmark of good, sound trading. Trading that will enable you to trade for the long term, consistently and profitably. And that's one of the biggest difference. So don't believe all the hype that you hear about trading 1,000 to 1 leverage and things like that. Just remember to have strict risk management rules in your portfolio when you're trading, and make sure you use margin as a benefit rather than a disadvantage.
So you can see just how important margin is to your trading success. It's these kind of terms that a lot of educators won't even tell you about, which is why it's so important that if you're going to start trading and you want to do it the right way, then you click on the link below, register for your free local trading workshop so you can learn everything you need to know about trading the foreign exchange market and how to do it the right way. In the meantime, watch out for the next episode where we're going to be talking about technical analysis and how traders use it to their advantage. I'll see you next time.